This is a podcast by the Straits Times.
Hello, I'm Lynda Hong, Assistant Podcast Editor at the Straits Times. You're listening to In Your Opinion, a podcast series on Wednesdays that takes a hard look at social issues of the day. Now, the people buying million-dollar HDBs and condos right now are millennials and older Gen Zs. They were born in the 1980s and 1990s, when Singapore's TFR was already steadily dropping below replacement rate of 2.1 at around 1.7 to 1.4. Because they come from smaller families, they will have benefited from the bank of mum and dad. And just like how past demographic shifts drove current prices, the latest TFR of 0.87 will continue to have an impact on the property market in around 2050, when today's shrinking cohort of babies will enter the market to buy their first homes, and when the baby boomers and Gen Xers are passing on their massive stockpile of leasehold flats. In this episode, we unpack the demographic plot twist, how childless couples and the bank of mum and dad are keeping prices high, and if the market will actually feel the crash. To discuss this, I'm joined by an observer who has been watching the Singapore market for at least 20 years. Executive Director of Research and Consultancy at Savills Singapore, Alan Cheong. Welcome to the show.
Lynda, thank you very much for having me here.
Okay, now Alan, let's start with this absolute foundation of the property market. Textbook economics says property prices are driven by core pillars: interest rates, wage growth, and physical supply. Now, the ultimate foundation is humans, right? If there are no people, there's no real demand. Right now, how do you weigh these factors? Are our current high prices being driven more by cheap liquidity and wage growth, or is it pure underlying human demand?
At the macro level, it all boils down to supply and demand. But when you try to split it into the demand side of the equation and the supply side, we say firstly focus on the demand side. The demand side is driven by many other factors, one of which is like what you mentioned, human and interest rates, which may or may not, in the case for Singapore, have a bearing on property demand. And last thing would be sentiments. And I think sentiments amongst the three is the greatest driving force here in Singapore. Then on the supply side, it also takes a supply policy to be able to regulate prices and rents on the private and public residential market.
So you also mentioned sentiment, right? Out of these pillars that we were talking about just now, which one has the single most power to move the market, and how does it actually move the markets? Maybe you can also describe a little bit about that.
On the demand side, sentiments is very important, and on the supply side, government land sale policies are also very important, and government policies on buying private and public housing has also a great influence on the overall demand-supply interaction. On the demand side of the coin, I guess sentiments plays an important part, because without sentiments, you may have the wherewithal, either individually as a buyer, or you are using your father and mother's money. You still need to have a good sentiment, feelings, in order to commit to the purchase. So sentiments has all the while been important, and more so today, with about 35,000 agents in the market, and with social media plus free flow of communication through WhatsApp and other medium channels, you have those 35,000 going out there evangelizing to the market, which is something that we do not have prior to agents waking up to the fact that you can use social media to promote your cause. So in the 80s, 90s, 2000, early 2000 to even a decade ago, social media wasn't that widely used to promote property. And today we have them posting on YouTube, TikTok, WhatsApp, sending out messages on WhatsApp. And all these shots actually go to populate and flood the mindset of buyers. And together with the fact that Singapore is perceived to be a safe haven, people in Singapore on the demand side seems pretty inured to what's happening around the world. So what's happening now, you will notice that at the end, people are fearful about the wars in the 90s, from Operation Desert Shield to Desert Storm, Iraqi Freedom. People sort of bulk at buying. But after seeing prices rebound, especially after the global financial crisis when they let in the foreigners and that overcome negative sentiments, people begin to feel that, hey, we throw caution to the wind. I don't think the market is going to come down. And so sentiments, people adapt to negative expectations, negative sentiments, and they try to leapfrog over that. And I believe that with the power of social media, that has actually created a different format, different structure, different equation for the demand side of the coin.
What's going to change sentiment? Are there any real issues that could change sentiment going forward?
Sentiments can change if perception based on, the feel-good factor gets a rude awakening. If there's a physical impact on the economy, it's either physical impact through the economy or physical impact through bodily harm. And then people begin to wake up, hey, it is not exactly that safe at the end of the day. And this is where I believe that through all the perception and all the feedback loop about this thing being a safe haven, it can be toxic because you are inuring people to take precaution against what may be outliers in the event of, say, 2 standard deviation, 3 standard deviations in the norm of volatility as proxied by stock prices. If people overlook those factors, a day will come where you have perhaps a Six Sigma event, and this one bursts through all barriers and all perception, and it becomes a physical impact. Say, interest rates rise, mortgage rates rise to 5%, and nobody would believe that, right? And that pillar collapses, it will have an impact on asset prices like real estate.
What about TFR then? We're seeing TFR going lower over the years. Is that going to curb real demand?
TFR driving property prices is like saying the tail wagging the dog. TFR is driven by a couple of factors. One is socio-economic, second is culture, the third will be government policies. It's coming down, and that hasn't really stopped property prices from rising, or so-called falling, but if you look at the situation, you see TFR has been coming down, GDP has been growing up, household size has been falling. What it means is that the GDP is now being compactified into fewer and fewer people, Singapore citizens, or the local demographics. In other words, the falling TFR meant that the Singapore parents could have more savings per child, and that is driving so-called affordability in terms of the equity down payment. You may have a TDSR that requires a high equity down payment, and then the kids then take over the mortgage. But it is the clambering over the equity down payment of 25-30% that the parents are putting that out for them, and thereafter they use their monthly income to pay for the mortgage. So far that has worked pretty well. If for whatever reason the Gen Zs and the Millennials cannot get a job or becomes structurally unemployable, then we will have a problem, but that will be sometime down the road.
So talking about this mom and dad, the bank of mom and dad, right? Are we seeing this trend where young buyers have actually massive purchasing power that's backed by concentrated wealth of their parents? Is this an uneven playing field?
When we are looking at the 1-bedder and 2-bedroom private condos, right, I think that's more the case where you will see greater parental support in terms of the equity down payment. But when you move to the 3, 4 and 5-bedders, most of them are from the HDB heartlands. They are upgraders. So there are 2 classes there. There are 2. A typical condo launch is bifurcated to 2 classes of buyers. One who rely on, I wouldn't say all of them, but quite a few will rely on parental support. and the other will be relying on their supernormal profits from their sale of the HDB flats. So father-mother money is important or plays a significant influence in the 1 to 2 bedder sort of apartment sizes.
From what you say about all the 3 to 4 bedders, private condominiums being purchased by HDB upgraders, it sounds like they don't really think of the ABSD, or it's not a very big factor for them to pay 20% on top of the purchasing price of the private property price. Is that how I'm reading this?
I think they can go around the ABSD thing by going around to rent in the first place, to rent the apartment after they sell the HDB. And so you skirt that 20%. Now, because if you sell the HDB first, before you buy the private, but you have to be prepared that the launch is going to happen soon and you've eyeballed that particular property. So you are okay with that.
So you have to time your selling and your buying quite nicely.
Yeah. So besides, falling back on mom and dad money, we must also remember that in the past 2 years, quite a few people made money, especially the millennial and the Gen Zs, made money from crypto and foreign equities, especially US tech stocks. And they may have assimilated quite a fair bit of savings from there. So we have father-mother money, profits from equity and financial investments. So these two come together for demand that comes together to whet demand for 1-2 bedroom apartments.
So let's look at this 20-year trajectory. The government has spent years trying to prevent the market from overheating. We've seen ABSD being introduced for about more than 10 years. We've also seen LTV for loan-to-value ratios for the HDB housing market in the form of the mortgage servicing ratio, or MSR. So is this 0.87 TFR be sort of a ultimate cooling measure over the 20 years, since we're going to see our native population shrinking?
A couple of things that can go against this TFR falling, which we conventionally would think that it will lead to falling property prices. One is immigration, which we do not know. There could be, the pursuit of continuing immigration of highly skilled workers. And number two, we have the declining household size. Currently, we have a household size on average of 3.06.
That means there are 3.06 people in one household, in an apartment, so to speak.
Yes.
Okay.
And if you look at what is above this 3.06, what sort of housing types have a higher household size? It starts from 4-bedroom HDB flats, 5 non-landed private properties, and then finally landed. And for landed, we have a household size of about 4, about there, which means that we have we're likely to see disaggregation in terms of household size. It will start to fragment, and the bigger the household size, like those in a landed property, it's going to be like a fragmentation grenade. So they got more to spawn out as household size start to shrink. So these will continue to feed into the private housing side of the equation, and also some private public housing. And we will see that partially overcoming the falling TFR. The TFR today will only affect perhaps housing demand in 30 years' time, because they were born today or yesterday, last year. But in 20 years' time, you should look back at the TFR 10 years ago, which is still low, I think, but it's still at 1. It's not at an alarming situation. We have countries like South Korea with an even lower TFR, and yet housing seems unaffordable. So the link between house prices and TFR is partially diluted or weakened, or it is just one of the links amongst other various factors. And the other factor that will affect house price will be what is the government supply policy moving forward. They could pull back the throttle on the supply or they could increase the immigration to increase demand, or they could just say, okay, we could recalibrate the cooling measures to make it more affordable, right? Lowering the TDSR, etc., etc. So there are many factors that play moving forward. So it's not a foregone conclusion that a falling TFR will lead to falling property prices. So we have to be dynamic in this analysis and not take things in a ceteris paribus manner.
So going forward, we have always been boosting our population with immigration. Do you see that as a way to prop up property prices going forward?
Moving forward, I do not think that immigration is the panacea for the economy, not only just real estate. Because we are moving into an age of uncertainty and we are seeing more and more outliers happening in the geopolitical field. Then we have AI coming in. You may say AI can't do plumbing now, but in 20 years' time, AI may be able to do plumbing. AI can do many things like even social work. If it improves, if it continue to improve. We cannot just say, oh, technology is static today, and what they cannot do today, tomorrow, they will not be able to do. They may be able to do, and that's the human spirit, right? If you say you can't do it, you overcome and you will improve on it. That you win perhaps then you get your $1 billion paycheck. Now, technology will improve, and then that what leaves us as humans. And today, if you say you are a talent, perhaps in 3 years' time, given the technology cycle, you may not be a talent. And you bring them in, if they are PRs, fine. But say if you make them citizens, they will then become a liability to the economy, weighing down healthcare systems, weighing down our transportation systems, education system, etc., etc. So at this transitionary stage, it is actually pretty risky to continue pushing the immigration policy moving forward, because human beings are at this juncture where we are not able to answer the question whether we will be made redundant by machines. And nobody out there, even at the frontier AI company models, have really thought about how to resolve this. Everyone is just pushing breakneck towards AGI and beyond that super intelligence, because everyone wants to kill off the opponent. And also there's a AI war between the US and China. They can't stop. And yesterday's best ideas maybe become tomorrow's poison.
And today's talents might not necessarily stay the same as yesterday. I mean, that's essentially what your point is, because Singapore has always... its immigration policy has always been based on how much you can contribute to Singapore society in terms of your skills. So in that sense, is that what I'm hearing from you, that their skills might not be relevant to tomorrow's job market or economy even? Yeah,
you're right. Their skills, or what you think they are good at today, is what you think you are. Policymakers will think this is what they think it is, or they are valuable for. But where's the predictive power of all these policies? Do they know what's going to happen in 5 years' time? Well, 2019 till now, I think they didn't know that there's AI, generative AI, and that has upset a lot of the entire tech ecosystem, hiding under AI washing. But at the same time, companies are now redeploying capital to fund their AI programs. And that leaves people who were previously extremely skillful in Web3, Web2, software design, software development, who were then considered, big talents, right? We must have them. Today, they are almost redundant. So entering a university in 2021, 22, taking up a top-notch course in tech, and what do you get today? You struggle. I think maybe you may end up as a data entry operator.
We're not sure how the job market is going to be going forward, but one thing we know about is that there are a lot of flats in Singapore that's going to become older around 2040, 2050. So we actually have seen this verse that's being announced, which is the Voluntary Early Redevelopment Scheme. With VERS going to voting, which we actually have heard from the government that they will actually do, is that going to be a feasible option for them to be doing, given that people will actually be aging as the flat ages as well?
On paper, yes, voting seems the fairest way out. Unfortunately, human beings, their brains do not think straight, especially when you're getting on in age. So cognitively, they may not be there to be able to think straight. And that would frustrate people who want a verse. And then how are you going to resolve this? You will only have a pretty sizable unhappy majority who are frustrated by people who are not thinking rationally. They may be rational, but they just, like, for example, they say, I don't want to move out. I've been living here for so long. But there could also be, and very likely there are people who refuse to speak logic or get, logic spoken into them. Then this will create a problem for verse to pass. One way out, and this is just one way, is if that person passes, then that flat gets taken out of the market. It is left empty. That will reduce the supply in the market. So gradually, as more gets taken out, you will pass a point where you may be able to pass the verse vote because the aging population then takes care of itself, and that reduces supply, and you may possibly get the remaining residents who are more likely to be rational because they are younger in age, right? And they may pass the verse.
So within the flat, we will actually see some empty flats going forward in your scenario.
Yes, you will see more empty flats. A point in time will come where for some blocks, there will be more empty flats than there are lighted flats. That means the remainder, you perhaps can reach out to them either to sell or to do a verse. But for now, because we are not there yet, I think verse is something you can set on the table for fine-tuning.
Could you maybe just discuss about this timing, right, when it hits the 70-year mark and the government has to sort of review the compensation package in 2030s? What is actually going to be like? Maybe we could take a look at how the government is going to set this verse going forward.
It's pretty difficult to forecast what will happen to the 99-year properties. Some still hold on to the idea that there will be en bloc. Somehow you'll be selectively en bloc. Then the verse thing is pretty difficult when especially you're dealing with the older generation living in all these older flats, right? They may not be thinking straight. Young people may be frustrated and not buy all these flats. So we see values start to come off over time. At this juncture, maybe the best is still leave with verse first and let the market decide, and it becomes very clear-cut what will happen to the values of those properties that will reach 10 years, 20 years before they hit the 99-year mark. Government will then have a clearer idea what to do with them, whether to continue with the verse or perhaps extend the lease life by another 30 years and turn it into a rental scheme.
But that's going to have a lot of flats anyway, right? I mean, if you're going to really turn it into a rental scheme, it's a bulk of flats that will all quickly build up.
By then, I think a lot of them would have died off. Those inhabitants, and you turn it into a rental scheme, then you build less BTO, you provide greater flexibility to the younger generation to want to rent, because we don't know what the job market will be with this AI age. In this AI age, we don't know whether their skills are relevant or not.
So rental might actually be a way to go going forward rather than owning properties in Singapore.
Yes, we have to change with the times. We just can't harp on, ideas that were 60 years ago. And then back then, home ownership was like something to make Singaporeans feel that they have a stake in Singapore. And so we have national service too, to defend the country. But moving forward, I think because the job market we don't know, and population is shrinking, maybe if you have a rental market, the TFR would reverse itself. Because if you have low rents, relatively low rents, you may see parents more willing to have children. And also at the same time, we can't just continue to expect that TFR will continue to fall. It will have to stabilize at a certain level, right? Now it's 0.8 something. It may stabilize at a level when you make the conditions right.
I also want to ask you about this classic Singapore dream then. It seems like if we talk about this future, right, where we all have rents and it's always been to buy an HDB flat, sell it after MOP and upgrade to a private condo. But if younger people are getting married and not having babies, does that fundamental HDB to condo upgrader pipeline start to break down?
That's why we are beginning to see father and mother money coming in. I don't completely believe that the late millennials and the Gen Zs are interested in real estate. Right? The old days where you say you need 4 or 5 Cs, I think that's passé. That's so outdated. They want the experiential thing in life. Travel, your matcha, they even drink less beer, right? That we see beer companies starting to restructure. So we have a situation that the parents, they are using their children's name to buy a 1-2 bedroom, not because the kids want to buy and, they're thinking for the kids. It's more like they want to invest themselves with their surplus cash, but they cannot find a name to avoid paying the 20% ABSD. So they use a kid's name.
So are there more owners who are super young?
I would think that more than, say, 10 years ago. And this phenomenon of father and mother money came about in an increasing wave since 2017, 2018. Because I think it started with some marketing hype that tried to target at where can you extract demand from the older generation. So you say buy one for your kid. And the narrative was, if you don't buy for your kid, the kid will not be able to afford. So the parents are actually not really buying for the kid, not because the kid cannot afford, but if they are buying it because they themselves want to buy a property, there's another narrative that they have been sold, that real estate always goes up in Singapore.
So what if real estate doesn't go up next time? We talk about the rentals also. How would this actually affect the whole social aspects of Singapore then? Because you're not going to see a lot of people with assets then, because their assets are going to be converted or it's going to be decayed due to the lease decay.
You may see a K-shaped real estate market where the bottom K, the one that slopes down, are driven by those expiring leases.
What do you mean by the bottom K?
It's just a conceptual shape, like a K-shaped economy, a K-shaped society.
Okay, so you're referring to a chart.
A chart. Let's say a chart, they say you see properties below 50 years, they start to decline, the bottom leg of the K, downward sloping, and properties from 99 years of freehold all the way to, say, 70, 60 years, they continue to climb. That's how the market may develop itself into, and you will then have a bifurcation. To prevent the bottom K from happening, you can turn it into you still can have a bottom K.
The bottom K means the cheapest prices are dipping to...
The ones with left with fewer years in their lease life, you will see prices continue to come down. So that's the bottom K. It's a downward sloping price trend line. The upward sloping trend line is for freehold, 999, and brand new condos, or the condos will still have about 70, 60 years lease left. So it continues to rise. It's in demand because there's investment value in it. Those in the bottom leg of the K will be those that are deemed to have no investment value. So long as there's no lease life decay below a certain number of years, let's take it at, say, 60 years. 60 years
in 30 years.
And more in lease life left to freehold properties or 999-year properties, they still have the investment value. If there's no investment value, what are they? They will be properties that people deem that, it's going to run down to zero very soon. Why should I pay such a high price? And so property is like buying a car. It starts to depreciate in value. We see that in, say, industrial properties, JTC properties, 30-year lease. Once it gets down to a certain number of years, 15 to 20 years left in the lease, you see the value starts to be suppressed and it starts to go down. That's a K-shaped price profile we may get moving forward.
Are we going to see a lot of people being bankrupt with all this happening?
I don't think so, because the mortgage is about, for mortgage payment tenure, 25, 30 years.
So they still need to come up with some money to, in this scenario that you have talked about, we still need some kind of money to pay for rents.
I guess who would want to buy a property that's old in an estate or in a block that's surrounded by people that are aging? It's very unlikely that in future will be the Gen Alpha, right? It is unlikely that the Gen Alpha or the Gen Zs want to live next to, live in a block that is populated by people in their 70s, 80s. So you'll be like a ghetto, for lack of a better word. So I guess this is something that is not easy to resolve. You can't just flick a switch and separate out the sheep from the goats and say, okay, yeah, you guys go there, live together in something like a elderly block, and then the young, you can rent this block that's totally, where the older tenants have been chased out, so now you can rent. It's not so easy. I mean, I also know that certain things are just nice on paper, you can talk about it, but at least you should strive or aim to try to resolve this problem of this K-shaped price profile moving forward. Okay.
And you could possibly do this with supply, with policy. What does this policy include then?
I guess there has to be this. If you find that more and more people are aging and being removed from the population count, then turn some of these older flats into rental housing flats and give them the cash. Actually, you should just give them the cash. There's not much lease life, right? In, say, with 30 years left in the lease life or 20 years, some of these older flats, you can give them money, or in lieu of the money, give them a rental flat. You deduct off from whatever, and whatever is left over, if they pass on, you can pass to the next generation. So that's one way. So you remove the stock this way, slowly, bit by bit.
Well, that's a wrap for In Your Opinion. I'm Lynda Hong. Thanks, Alan, for your insights and for looking into the crystal ball with me.
Glad to be here, Lynda.
You can email us your thoughts on this issue. Also, if you'd like to read essay articles or opinion columns, these links can be found in our podcast show notes. This episode is edited by Teo Tong Kai. Thanks for listening.
Send your feedback to podcast@sph.com.sg. Find us on Apple Podcasts, Spotify, or within our Straits Times app. Thanks for listening.